Artificial intelligence isn't coming. It's already here. And it's not just writing college essays or generating cat images anymore. It's actually analyzing markets, rebalancing portfolios, making trades in milliseconds, and whispering financial advice into your phone, whether you realize it or not. Wall Street is using it, hedge funds are making insane profit from it, and retail investors, well, most of them are still figuring out what it even is. If you have ever wondered whether AI is a tool, a trap, or your ticket to early retirement, well, this one's for you. Welcome to the Smart Money Countdown, where personal finance meets punchy, fact-packed breakdowns. Every Tuesday and Thursday, we give you the 15 things that you need to know about what is trending in money, investing, and building real wealth, while on Sundays, we make deep dive videos. Subscribe now if you want to make smarter money moves without spending hours reading through another finance book. Anyway, let's break down 15 things that you need to know about AI as a retail investor. Number 15. AI is already making decisions about your money, even if you didn't ask it to. Now, you might think you're in full control of your money, but AI has been poking around your portfolio like an overconfident intern who read half of The Intelligent Investor. If you've ever used apps with smart notifications, congratulations, you've been AI handled. These platforms are designed to optimize, rebalance, and alert you based on behavioral finance models, powered by machine learning. It's kind of like having a digital financial advisor whispering, "Buy the dip," except, well, it never actually sleeps and doesn't care if it ruins your day. You didn't opt in to Skynet Finance, but here we are. Most users aren't even aware that these tools are behavioral data to automate suggestions that feel natural but are entirely machine generated. It's like your financial destiny has been handed to an invisible robot that thinks it knows better than your accountant. Number 14. AI doesn't get tired, but it can get confused. AI is working 24/7. It doesn't get hungry, it doesn't get moody, and it definitely doesn't get angry like you do when the market dips and your Chipotle order is wrong. But here's the catch. It can still totally misread the room. If a tweet says, "Tesla is on fire," AI might panic sell because it thinks that the factory burned down, not that the stock price is booming. It doesn't understand nuance, it doesn't get sarcasm, and it has the emotional IQ of a microwave. AI is running 24/7 with zero fatigue, yes, but that doesn't mean it won't trip over an emoji-laced tweet and mistake it for a financial meltdown. It reads data fast, but without context. It's just speed-reading nonsense. For example, a single misprinted headline can cause a bot to dump shares. AI does not understand, it interprets. And interpretation without context is the financial version of asking a toddler to explain quantum physics. Number 13. Most AI tools are just fancy calculators, with good marketing. Have you ever noticed how every fine tech startup now claims to be AI powered, even if all they do is round up your purchases and dump spare change into an ETF? Many of these AI engines are just advanced if or then formulas with great branding. They're not deeply learning models. They're simply glorified spreadsheets dressed in buzzwords and a dark mode UI. Just because it has a slick dashboard does not mean that it's about to turn you into the next Warren Buffett. Not all AI is deep learning. Some of it is just old school dressed up with buzzwords. Many of the robo-advisors labeled AI-powered are just running on decision trees and pre-programmed logic. They follow some rules, not intuition. Think of it kind of like Excel with better branding and, well, a slightly smug attitude. If it can adapt to real-world complexity or learn from evolving data, it's not artificial intelligence. It's artificial confidence. Number 12. AI can help you stop emotional investing. Now, this one is a big win. If you're the type of investor who panic sells the moment your portfolio drops 5%, AI can save you from yourself. Robo-advisors, for example, rebalance your portfolio without flinching. They don't have bad days, they don't get FOMO when they see crypto mooning, and they certainly don't rage buy because their cousin made money on Dogecoin. AI does not chase the hype, it sticks to the plan, which, come on, let's be honest, is far more than we can say for most humans. AI doesn't feel fear when the S&P 500 drops 3%. It doesn't revenge trade after a bad loss. And that's good news for retail investors who are emotional wrecks with Robinhood notifications turned on. AI's greatest strength might be that it never deviates from the plan, even when you're tempted to throw it all into Dogecoin. It doesn't chase the shiny objects or follow the TikTok hype. It sticks to the system, and for most people, that kind of consistency is exactly what their finances need. Number 11. AI still struggles with black swan events. Now, let's talk about what AI doesn't handle well. Surprises. Global pandemics, flash crashes, Reddit-fueled meme stock explosions. All things that confuse even the most advanced algorithms. These systems are trained on past data, not psychic visions. So when COVID hit or GameStop started acting like a rocket ship, most AI trading models tripped over their own wires. If you're expecting AI to shield your portfolio from every freak event, well, you're gonna have a bad time. AI failed to predict COVID-19, the Russian-Ukraine war, and the great toilet paper shortage of 2020. Why? Because it is trained on historical data, not chaos theory. If it's never seen it before, it simply can't process it. So when the unexpected hits, AI tends to either freeze up or react based on outdated assumptions. And in those moments, it's less genius robot and more confused Roomba bumping into the wall. Number 10. Some retail traders are building their own AI bots, with varying levels of chaos. There is a wild subculture of DIY investors coding their own AI bots using ChatGPT and Python. These bots are scanning news headlines, tracking stock sentiment, and even executing trades. One guy trained his AI to think like Warren Buffett. Another built a meme stock sniffer that follows Reddit trends. And sometimes they win. Most of the time, though, let's just say that the bots, well, they need some therapy. Is it a cool idea? Yes, but is it foolproof? Absolutely not. If you go this route, just know that you're walking into a digital casino wearing a homemade tinfoil helmet. Retail investors are using AI to code bots that analyze stock sentiment, execute trades, and even run backseats on past market performance. It's a brave, nerdy new world, but with very mixed results so far. Some bots mimic professional quantum models, while others crash and burn after misinterpreting Reddit memes. Now, unless you understand Python, machine learning, and risk management, building your own AI bot, it's a high-stakes hobby. Number 9. Wall Street's using AI to front-run you. Here is the cold truth. Hedge funds have AI systems so advanced that they make your robo-advisor look like a Tamagotchi. These models read satellite data to predict store traffic, scrape global sentiment in real time, and parse earnings calls for voice tone changes. Some even use image recognition to see just how full parking lots are at retail chains. You're not competing on the same field. You're competing on a PS2 while they're in a quantum simulator. So, if you think your retail investing app's AI insights will help you beat Wall Street, well, good luck, but also no. The big players aren't using the free version of ChatGPT. They've got multi-million-dollar proprietary AI systems sniffing out alpha. These models analyze sentiment, track weather patterns, and even monitor shipping container movements from space. I mean, they act before you even realize a trend is happening. Retail investors playing catch-up with these systems are like showing up to a Formula One race with a bicycle. The information edge isn't just unfair, it's borderline science fiction. Number 8. AI is great for research, but don't trust it blindly. One of AI's best uses? Time-saving research. Ask ChatGPT to summarize an earnings report, compare ETFs, or explain an economic term, and boom, instant clarity. But trusting it blindly to build your investment strategy, that's like letting a Tesla drive you through a thunderstorm while you nap in the back seat. It might be fine, until it isn't. AI simply doesn't understand you. It doesn't know your retirement goals, it doesn't know your tolerance for risk, or your deep emotional trauma from 2022's tech crash. If you need a summary of Apple's last earnings call or a quick ETF comparison, sure, AI's got you covered. But if you're using it as a sole decision maker, you are flirting with disaster. AI does not know your financial goals, your income, debt, or risk tolerance. It's giving you ideas, not advice. Think of it as the world's fastest intern. It's useful, it's brilliant, and absolutely not responsible for what happens next. And hey, if this has been helpful so far, make sure to hit that subscribe button. We break down trending money topics just like this every single week. Don't miss the smart moves that build real wealth. Number 7. AI can be biased, just like people, but it pretends it's not. Here's the dirty little secret. AI learns from human data, and human data is messy, biased, and full of bad decisions. If an AI model is trained on biased market data, it can reinforce flawed strategies. In other words, if the dataset thinks that the tech sector is always a good bet, guess what your intelligent investing tool will keep recommending? Don't let the digital voice fool you. It's only as objective as the people who built it. AI models absorb biases baked into the data that they're trained on, meaning they can reinforce flawed market assumptions. They may favor large cap stocks, overlook emerging markets, or mirror outdated investors' behavior. And it's this that can skew your portfolio in ways that feel optimized but are subtly flawed. Bias in AI isn't always obvious, which makes it even more dangerous. It's like getting financial advice from someone who's confident but wrong. Number 6. AI can make you feel safer than you are. Now, this one's sneaky. The better AI gets at doing stuff for you, from choosing your asset allocation to analyzing trends, the easier it is to think that you're suddenly a financial prodigy. Well, you're not. Just because your robo-advisor returned 9% last year doesn't mean you've cracked the matrix. That was the algorithm doing its job. Don't confuse "I used a good tool" with "I'm basically Ray Dalio now." Overconfidence is the most dangerous side effect of automated investing. When your AI-generated portfolio goes up, it's easy to assume that you've cracked the system. But spoiler, you haven't. You're riding the wave of an algorithm, not walking on water. It's this false confidence that can lead to reckless decisions, like abandoning your strategy because, "Hey, I got this." Reality check: the moment you outgrow humility in investing, you start buying the dip on vibes. Number 5. You still need to understand the basics. AI can execute your trades, it can balance your portfolios, and even offer you suggestions. But it will not save you from not knowing the difference between a Roth IRA and a ramen packet. If you don't understand the why behind your investments, you're handing your future over to a black box. And that's not smart. That is passive to the point of reckless. AI can enhance your investing, but if you're relying on it because you're too lazy to learn the basics, well, congratulations. You've built a house on autopilot with no clue what the foundation is made of. If you don't know what diversification means or how capital gains tax works, no AI tool is going to save you. You still need to know why your portfolio looks the way that it does and what each asset is doing there. Otherwise, you're investing blindfolded with a robot co-pilot who refuses to explain anything. At best, you'll muddle on through. At worst, you'll misinterpret everything and panic at the first red arrow. AI is a supplement, not a substitute for actual financial literacy. Number 4. AI can protect you, not just grow your portfolio. Now, let's shift gears. AI isn't just for making you money. It can help you keep it as well. Some tools use AI to track unusual financial behavior. Some investment apps use AI to monitor for fraud, flag suspicious activity, or alert you when you're getting gouged by fees. Some AI-driven tools scan for fraud, detect unusual activity in your accounts, and even flag high-fee funds draining your investments. It's kind of like having a financial watchdog that never really sleeps and doesn't charge 1% AUM. These features aren't as flashy as stock picking, but they matter just as much. AI can send you alerts for excessive drawdowns, unusual volatility, or account access from suspicious IPs. In short, it can lock the doors while you're focused on chasing yield. Number 3. AI can spot patterns that you'll never see, but that doesn't mean they matter. AI is freakishly good at pattern recognition. It can tell you things like, historically, small cap REITs outperform when corn prices rise during election years with the Democratic Senate. And that's pretty neat, but also, what? Just because it found a correlation doesn't actually mean that there's causation. AI might show you patterns that technically exist but have zero real-world relevance. So use those insights with caution. They're fascinating, sure, but don't bet your retirement on a stock just because the moon phase aligns with bond yields. AI can analyze millions of data points and surface obscure correlations, like energy prices affecting semiconductor stocks during election years. Impressive? Sure. Actionable? Not always. Just because it finds a pattern doesn't mean it found a strategy. Retail investors often chase these signals and end up with overly complex portfolios full of noise. Sometimes the simplest insight, like buy broad ETFs and chill, beats all the pattern recognition in the world. Number 2. AI will widen the wealth gap between informed and uninformed investors. Okay, let's get real. AI is not going to level the playing field. It's going to split it up. The investors who learn to use AI tools wisely, as assistants, not crutches, will build smarter, faster, and more resilient portfolios. Those who rely on TikTok money hacks or emotional hunches, they'll be left behind. In this new era, the gap won't be rich versus poor, it'll be data literate versus data illiterate. Those who embrace AI strategically without becoming overly dependent will build some serious long-term advantages. And those who ignore it or misuse it, they'll simply be left behind. In the AI era, information isn't just power, it's leverage. And knowing how to use AI is the new literacy. And just like reading, it separates the builders from the bystanders. Number 1. AI is a tool, not a shortcut. Here is the most important thing you need to know. AI is not magic. It's not some special cheat code. It's not a money printer. It is a tool, a powerful one, but it still requires strategy, input, and responsibility. If you treat it like a shortcut, you'll get shortcut results, shallow growth, blind risk, and painful surprises. Use AI like you'd use a calculator, helpful, but useless if you don't understand the equation. The biggest lie, though, is that AI will do it all for you. That kind of thinking creates lazy investors who blindly trust outputs without understanding inputs. When used correctly, AI can enhance your judgment, speed up your analysis, and automate your tedious tasks. But if used poorly, it becomes a digital crutch that quietly leads you off a financial cliff. Your job is still to think. AI just lets you think a little faster. But your turn. Have you ever used an AI-powered investing tool, or even tried asking ChatGPT for stock advice? Drop your experience down in the comments section below, and let us know if it helped. And if you found this video helpful, be sure to hit that like button, subscribe for more smart moves that build wealth, and share this with someone who's still trying to hustle their way to financial freedom. They probably need to hear it.